Have you ever watched the market crash, felt the urge to buy the dip, and then either bought too early or missed the move completely? Today we're breaking down the Dip Buyer Playbook, a practical framework for how to deploy capital after a sell-off without guessing, gambling, or letting emotions control your decisions. Because here's the truth most investors learn the hard way. Buying the dip is easy to say, but extremely hard to execute correctly. Right now, searches for phrases like buy Bitcoin, crypto dip strategy, and when to buy after a crash are rising again. Markets move fast, sentiment flips overnight, and investors who have a structured plan often outperform those reacting emotionally. In this video, you'll learn how professional investors approach market pullbacks, how to scale into positions safely, and how to manage risk so one bad entry doesn't destroy your portfolio. By the end, you'll have a clear dip buyer playbook you can actually follow the next time crypto sells off. Let's start with the first principle most people misunderstand. The biggest mistake investors make during a sell-off is assuming price alone tells you when to buy. You see red candles, panic across social media, and suddenly everyone says the same thing. This is the bottom. But markets don't bottom because they look cheap. They bottom when fear peaks and selling pressure slows. A proper dip buyer playbook begins with understanding market phases. After a sharp drop, markets usually move through three stages: panic, stabilization, and recovery. Most beginners buy during panic because prices look attractive. Experienced investors wait for stabilization signals. Ask yourself this: are sellers still rushing out, or is volatility starting to calm down? Look for signs like smaller candles, reduced liquidation spikes, or price holding a key level multiple times. These signals don't guarantee a bottom, but they tell you risk is improving. And this leads to the second rule: never deploy all your capital at once. One of the strongest crypto investment strategies is scaling entries. Instead of trying to perfectly time the bottom, you divide your capital into portions. For example, imagine you want to invest $10,000 during a sell-off. Instead of buying everything immediately, your dip buyer playbook might look like this. First allocation when price reaches a major support level. Second allocation if price consolidates and holds. Third allocation only after confirmation of strength. This removes pressure from being right instantly. You're not predicting the bottom. You're participating in the recovery. Here's a question for you. Would you rather be perfectly early once or consistently positioned across many cycles? Most successful investors choose consistency. Now let's talk about something almost nobody includes in their dip buying strategy: risk control. Buying dips without risk management turns investing into gambling. Your playbook needs a defined invalidation point. That simply means deciding in advance where your idea is wrong. If Bitcoin breaks a major structure level or the market narrative changes, you reduce exposure. This protects your capital so you can buy future opportunities. Remember, capital preservation is what allows long-term growth. Many viewers assume great investors win because they always pick the right entries. In reality, they survive because they control losses. Now here's where psychology becomes critical. During sell-offs, social media becomes extremely emotional. You'll see extreme fear and extreme confidence at the same time. Some people call for zero. Others scream that it's the opportunity of a lifetime. Your dip buyer playbook exists to remove emotion from decision-making. Instead of asking, "Is this the bottom?" you ask structured questions. Is liquidity returning? Is selling momentum slowing? Is my position size aligned with my risk tolerance? When you follow a checklist, you stop reacting to headlines. Let's move into a powerful concept used by experienced crypto investors: buying strength after weakness. This sounds counterintuitive. Most people want the lowest price possible, but markets often reward investors who wait for confirmation. A recovery signal might include reclaiming a key moving average, breaking a short-term downtrend, or increased trading volume on green candles. You're not buying the absolute bottom. You're buying proof that buyers are returning. And surprisingly, this approach often reduces stress while improving results. Think about it like this. Catching a falling knife feels exciting, but riding momentum feels controlled. Another critical part of the dip buyer playbook is allocation strategy between Bitcoin and altcoins. During uncertainty, capital usually flows into Bitcoin first. Altcoins tend to recover later but move faster once confidence returns. That means many investors accumulate Bitcoin during fear phases, then gradually rotate into stronger altcoin narratives once the market stabilizes. This isn't about chasing hype. It's about understanding liquidity behavior. Now let's talk about timing expectations, because this is where patience becomes your advantage. Many investors expect instant rebounds. But historically, markets often move sideways before trending upward. This phase is boring. It shakes out impatient traders. But for disciplined investors, consolidation is where positions are built quietly. Here's an important question. Can you stay confident when nothing exciting is happening? Your ability to hold during boredom often matters more than your entry price. Another overlooked element is keeping cash reserves. A strong dip buyer playbook always leaves unused capital. Why? Because markets frequently create multiple opportunities, not just one. If you deploy everything too early, you lose flexibility. Liquidity equals opportunity. Now let's bring everything together into a simple framework you can remember. Step 1. Wait for panic to slow, not just price to drop. Step 2. Scale into positions instead of going all in. Step 3. Define risk before entering. Step 4. Look for strength confirmation. Step 5. Keep reserves for future volatility. Notice something important. None of these steps rely on predictions. They rely on process. And process is what separates investing from speculation. Markets will always create fear cycles. News headlines will always exaggerate moves. But investors who follow a structured dip buyer playbook remove chaos from their decisions. Before we wrap up, here's one final insight. The goal isn't to buy the lowest price. The goal is to build positions during moments when others are too emotional to act rationally. Over time, disciplined execution compounds far more than perfect timing. So the next time crypto drops and everyone asks, "Should I buy the dip?" you won't rely on hope. You'll rely on a system. Let's quickly recap. A successful dip buyer playbook focuses on structure, not prediction. You scale entries instead of rushing. You manage risk before profit. You wait for stabilization signals. And you preserve capital so you can stay in the game long enough to benefit from recovery cycles. Markets reward preparation, not panic. If you found this helpful, let me ask you something. When the next sell-off happens, are you more likely to buy immediately or wait for confirmation? Drop your answer in the comments because I read everyone, and it helps shape future videos. And if you want more practical crypto investing strategies explained simply, make sure you like the video and subscribe so you don't miss the next breakdown.